All right, everyone, welcome back to Ryan Miller Trading Economics Framework Part 3. In Parts 1 and 2, we went over the fundamentals and technicals, so if you haven't checked that out, go and do so. Otherwise, this video is going to be on putting those two together, putting the fundamentals together with the technicals. Okay, so let's get into that. So I'm going to give you an example. Not going to get too in depth. I'm going to go through a bunch of indicators, but I'm just going to kind of list them out, what an idea of what I'd be looking at. Not going to get in depth in any of the indicators. We'll do that in the actual video breakdowns. I just want you to get the gist of how you can actually combine the fundamentals with the technicals. So we're going to use an example with the cyclical Russell 2000. Okay, as we all know, just like all the major indices, they were trending up since 2020. They were in this long uptrend. And then in November, they peaked, right? Russell 2000 peaked, started falling, right? So how do we know if we're getting a potential move to the downside, right? A change in the trend. If you remember from our technicals, we're looking for a pivot low, right? A major structure to be broken. So we had this swing low here, and it got broken down right here in January. Boom, got broken down right in January. So how do we know if this is the right time to get short the Russell 2000, right? How do we know whether this move is in line with the fundamentals? That's the whole purpose of this, right? We don't want to just look at the fundamentals and then they say, oh, an asset should be moving this way and just get in because you can be sitting in a losing position for months at a time. The technicals are going to provide more timeliness in getting into our positions, which ultimately is going to reduce our risk. And that's the whole purpose of this, to time the market better to reduce risk. Okay, that's why we're combining the technicals with the fundamentals. So after a break, if you remember from part 2, after a break of structure, you always get a pullback, and that's what we got here. Okay, so you could have been aggressive, right? Because we have a high here and then a low. Right? If you remember, high, low, and then we will be looking for a lower high followed by a lower low to say we're officially in the downtrend. But if you wanted to be aggressive, you can get in right here in January. We broke this pivot. We have a high, a low. The question is this broken pivot here, is this move to the downside in line with the fundamentals? So if we go about January 20 of this year, 2022, let's start looking at some of the fundamentals. Well, first, let's look at the coincident data. Coincident data tells us where we are right now, right? Where the economy is right now, not where it's headed, but where it is right now. And all 4 pieces of the coincident data, real income, real consumption, industrial production, and employment peaked in about April, May of 2021 and had been slowing since. So that tells us the economy has been slowing since about April, May of 2021. So this is income. If we go to about January, where are we? We're down here. So we were in a continued slowdown. Here's January on consumption, economy slowing down. January on production in a slowdown, and we've been flat for a little while in employment, but as you can see, still in a slowdown. So that tells us where the economy in January 2020 was slowing down, but is it going to continue to slow down? How do we know that? So we look at the leading indicators. Remember from part 1, we have long leading and short leading. We're going to look through a few pieces of long and then a bunch of short leading indicators and see what they were saying at that time. Like I said, I'm not going to go through them, what they mean, this and that. We're going to do that in the actual video breakdown. So real M2, okay, peaked in early 2021 and was contracting. By the time 2022 rolled around, it was falling. Now it's contracting, but it was falling. It was clearly in a downtrend at that time, telling us in the future growth is likely to slow, right? This has up to a 12-month lead time. Interest rates. So if we look at mortgage rates, corporate rates, and treasury rates, they're moving higher, right? Still moving higher. Let's see, beginning of 2022, they're just starting to move higher. They're just starting to move higher. So they're just starting this big move. So, but at the time we had interest rates moving higher. Interest rates move higher, slows the economy, right? So that's a leading indicator, longer leading indicator. Total residential spending, right? Total spending in the construction market deflated by the CPI slowdown. By the time we got to January, right around here, 2022, it was a big move to the downside, right? It slowed significantly. If we look at housing and durable goods as a percentage of GDP. So housing, private residential fixed investment, and then durable goods consumption as a percentage of GDP. This always leads recession. You're going to see a slowdown in this indicator in housing and durable goods consumption before every recession, leads every recession. And here we peaked in Q2 of 2021, which lines up with the slowdown that we just went over, and it had been slowing. By the time we got to Q1, it had been slowing. Right? Not a huge slowdown, but it peaked and started moving lower. It's a longer leading indicator. Now, if we start to move to some of the shorter leading data, let's look at, so what we're looking for here. So some of the longer leading data is telling us, okay, the economy is going to continue to slow. Those indicators are moving down. So what we're looking for are now the shorter leading data to have substantial moves to the downside as well, to coincide with that longer leading data. When it coincides with that longer leading data, that gives us a signal, say, hey, we got to start looking at certain asset prices for specific moves in the market, and then that's when we go to the technicals. But manufacturing PMI. I said manufacturing PMI. Is this the ISM? Yeah, ISM manufacturing PMI in January 2020. It peaked here in 2021. It was in a significant slowdown. It crossed its average, its long-term average, that fainter line there. It had already crossed that to the downside, and it was continuing to slow. ISM manufacturing new orders. Same thing. By the time January rolled around, it had already slowed and crossed below its average, right, to the downside. Durable goods new orders, right, excluding defense, big slowdown. We were already contracting by the time we got into 2022. Capital goods new orders, manufacturing capital goods new orders, peaked 2021. By the time we got into 2022, already contracting. Average weekly hours, right? This is a shorter leading indicator. By the time we got to January right here, we had already peaked and we're slowing. Not a big slowdown, but we're slowing, moving in the right direction. Look at a couple pieces of housing data, because housing is very cyclical. NAHB housing market index just crossing to the downside in January of 2022, crossing its long-term average. New home sales leading indicator. It slowed in, looks like 2020. It peaked in the end of 2020, started to move down at a bounce here, the end of 2021, and then started to roll over again in the beginning of 2022. Okay, so we have a lot of pretty much all the shorter leading data is coinciding with the longer leading data. Some of them had moved down substantially. A couple of them are just starting to roll over, but they're all pointing in the same direction, telling us that the economy over the next quarter, 2 quarters, should continue to slow. We look at the yield curve. Let's ignore the top part. That's the front end of the yield curve. That didn't start in flattening until just a few months ago. So if we look at the back end, which is these 4 charts down here, 2 and the 10, 10 and the 5, 30 and the 5, 30 and the 10, they all slowed down right in about April, March of 2021, and have been flattening. Yield curves have been flattening. By the time we got to January, right around here, it all flattened significantly. And we're showing signs that they're going to continue to flatten, right? That's an indicator that growth is slowing. We could potentially be headed towards recession, right? Yield curves flattening. If we look at the US dollar versus a basket of cyclical currencies, the Aussie, the Indian rupee, Brazilian real, South African rand, Canadian dollar, Chilean peso, Korean won. If this is moving up, that means these cyclical currencies are outperforming the dollar. If they're moving down, they're underperforming the dollar. right? So the dollar was outperforming these cyclical currencies as this line is moving down, which coincides with a growth slowdown. Peaked in, what a coincidence, April, May 2021, right when growth started to slow. So the short leading indicator. Okay, by January, by the time 2022 rolled around, it had slowed significantly. The dollar had picked up steam against these cyclical currencies. That coincides with all these other pieces of data that we were looking at. If we look at, say, this is the Russell versus the SPY, Russell versus the S&P 500, the ratio, when this line is moving up, means the Russell's outperforming the SPY. When it's moving down, the Russell's underperforming the SPY. During growth rate upturns, the Russell is more cyclical, so it outperforms the SPY, like we saw here in 2020 into, guess it, yep, March 2021. And since it's been underperforming, right, which coincides with a growth slowdown. By the time January 22 rolled around, where are we? Right around here, it had slowed significantly, right? So we have all these pieces of data. We have 4 long leading indicators. I don't know how many short we had there, 7, 8, 9, or if we include these ratios, 10, 11 shorter leading pieces of data, all pointing to the downside, telling us the economy is going to continue to slow. That coincident data, income, consumption, production, employment is going to continue to slow in the coming quarters, in the coming months. That tells us that the stock market is going to, at some point, reflect this, right? It didn't for a while, right? We had the growth slowdown right around here, and it actually went flat for a little while, and then it turned up. But then we had this move down, right? We had this move down, and it broke that pivot low right here in January. And all those pieces of data in January were telling us that the economy is going to continue to slow. So the technicals right here, when it broke that low, are now moving in line with the fundamentals. So now we know that that makes this move to the downside a much higher probability that it is going to continue to move to the downside, right? Because the fundamentals were telling us that. All we were waiting for is the technicals to now line up with that, to give us a higher probability that this move is not a fake out, right? To get better timing on it and to reduce our risk. And that's what we got here in January. And from a technical standpoint, anytime you get a break of structure, you're going to get a pullback. So if you weren't very aggressive and got in there, if you're an investor, you can use this time to get underweight the Russell 2000. You could use this time to short the Russell. However you want to play it, I'll leave that to you. But if you're traders, let's say you're waiting for a pullback from our technicals, right? We're going to wait for a pullback into supply right around where our structure broke. So there we have a supply zone that price pulled right back up into in March, April, end of March, early April. How do we know? Remember, we have a high, a low. How do we know a higher low is going to form here to then continue this move to the downside? Well, that's when I would drop down to say, let's just keep it simple, say a daily. And now I'd be looking on the daily for price to come out of this supply level and start breaking some structures to the downside. We have a couple of little structures, these minor structures that we talked about in framework part 2. Right, we have one right there. We have another right here. So the close of this candle here broke 2 structures to the downside. If you're a trader, you could say, okay, entry, stops going right above this, what we think is now going to be the lower high. Okay, and then oh, sorry, let me just get rid of some of these lines. Now we're looking to take it to the downside. Now we'd be looking to target, back to the weekly chart, we'd be looking to target the next area where sellers are likely to step in. And that's going to be the major area where sellers are going to step in is going to be where structure was broken, right on the other side. So here we had these big pivot highs here. Structure was broken to the upside. It never actually retested that. So we'd be looking to target that area. That'd be our first target. On the Russell, we'd be looking to target that area first. We know buyers are likely to step in there, and sure enough, they did. And that is pretty much it. Like I said, we'll get more into the indicators in the actual video breakdowns, but it really is that simple. You're looking for longer leading indicators to kind of set the tone. What direction are we going to be trending in the long term? wait for the shorter leading indicators to turn substantially in the direction of longer leading indicators and say, okay, now we're getting to the point where asset classes are going to start responding. Okay. Because in the shorter term, over the next few months, quarter, 2 quarters, the coincident data, which defines where the economy is going to start reflecting these longer and shorter leading indicators. So once that shorter data turns substantially and coincides with the longer leading data, that's when it gives us a signal, okay, we should start looking at the chart, start looking at the technicals. And then we're just waiting for a move on the chart, right? That lines up with the fundamentals. And sure enough, we got it right here. We got this break of this pivot low, potential trend change. That move is in line with the fundamentals, and we know there's a high probability that this move is not going to be a fake out, and it's not gonna continue to go back up because the fundamentals are in line, and the move is going to sustain to the downside, and that's what happened. That's what we're looking for. Okay, and that's pretty much all there is to it. It's very simple. Not always easy because you can get a lot of noise in these charts. You can get a lot of noise month to month in the economic data. Not always easy, but at the end of the day, it is that simple. Longer leading data influences short leading data, which then tells us where the coincident data is going to be in the coming months, which is then going to reflect in the asset prices. And then we're just looking for the technicals to line up with those fundamentals, right, for better timeliness, to reduce our risk. And that's it. Okay. First video breakdown will be in the coming days. Let me know if you have any questions about that. Otherwise, like, subscribe, and yeah, I will catch you in the next one.